Very seriously, that is really truly an honor for me to come here to celebrate for two important events for me. One is Wolfgang Hedler got a chair, which he certainly deserved, and he basically said my chair was worthless, his chair is much more expensive, which I certainly agree. And the second thing here, of course, is not very proud to be here for the 200 years birthday of Humboldt-University, which I admired since I was very young. And literally mean that it's really a lot of opportunity cost for me. Actually, I spent a whole week here, starting from preparation of these transparencies. So I could really just follow in, if I know Stigler's title, I could also call speculation and statistics too, right? That was really a similar subject. So really the talk today is trying to bridge the statistics and the finance. And actually this stands for a very simple question that I have a fun discussion with a hedge fund company, and in which they asked me saying that, well, they have 2,000 investable stocks they would like to invest in the emerging market, and asked me how do he select the stock. And so that is like, maybe I say, well, 20, 30, 40, he said, I'm not sure. But at the end of the day, he certainly has something in mind. It should be small enough that they can monitor the research, and on the other hand, should be efficient enough. And so this was the background. So the question that we really want to ask ourselves is, among a large, vast portfolios, how do I select a sparse one to allocate? And this is really the background of my talk. Okay, so this is the first we are asked myself, how to select a sparsely optimal portfolio amongst, well, thousands of stocks, maybe, or hundreds. And how do I use high frequency data to, well, shorten the time interval? And then the next question you may ask, well, how large the universe of assets you can handle? There must be some limit, mathematical limits beyond certain amount of assets in your portfolio. The error accumulation would exceed the signal. And the next question we ask is, how does the estimation of vast covariance matrix impact on the allocation vector as well as the portfolio risk? And in other words, how stable your portfolio with respect to to the estimation of covariance matrix. And this is very important. In a few moments you'll see, after all, what we are going to estimate is a time-varying covariance in the next holding period of, if you are a day trader in one day, if you are a long-term holder, it'll be in 1 month. And if you think about it, there's no way for you to know what next day's covariance matrix looks like, or what next month's covariance looks like. So at best, you are in the neighborhood. And when the covariance matrix is huge, so the impact of your allocation could be huge, could be small. How can we make it stable, insensitively depend on the estimation of covariance matrix? And this would be the outline of my talk. So I'll talk about portfolio selection with gross exposure constraints. I'll talk about covariance matrix estimation based on high frequency data, and then I'll illustrate simulation studies and empirical studies. So I admittedly that the result here is still unsatisfactory. That my student actually started over a year ago, but we just no program, and the handling data itself, it just take an enormous amount of time, and particularly after my student get a job in Wall Street, so certainly the motivation of finishing very carefully, numerical work become diminished somehow, but we are actually not improving, so as we go along, but we are in the critical points. So here's the introduction. The problem that we have is the Markovitch mean variance problem. So in the terminology of Steve, so you're trying to minimize the portfolio risk, as here, instead of arguing what is the appropriate measurements of risk, I just take the portfolio variance as risk, and subject to the constraint that you allocate all of your money in the market, whether it's a risk-free or not risk-free, you just put all money in the market, plus that you have a target return, let's say, expect target return 10%. And the solution to this kind of problem is very easy, and this is the solution to the problem, which certainly depend on the expected returns, divided by the covariance matrix. And this is certainly an important cornerstone of modern finance, where many beautiful financial economic theory has been built upon. However, if you think for a moment, actually it will getting you nervous. First of all, the mean vector, you don't really know, what is the expected return. If you really know for certain what the expected return, so that you know what to do better. And secondly, you have to invert a very large covariance matrix. So the result, is been very well known that the Markowitz problem, that is, you minimize the portfolio risk subject to the this constraint is too sensitive to the input vector as well as their estimation errors. And the certain problem get amplified when you do large portfolios. So let's imagine that answer to the question imposed by hedge fund. So suppose they had 2,000 stock in the universe they are interested in investing. And the 2,000 by 2,000 covariance matrix, this already involves 2 million parameters. And so estimating these 2 million parameters, each of those with some errors. So if you are really accumulating these 2 million parameters, so the resulting could have a devastating effect. So as a result, this would be the perceived risk, or the risk you get based on your empirical data. And the risk you want is without estimation. That could be quite different. And the ideal allocation vector that you want is something mathematical. This is the target function. And the allocation vector you get would be very different. And I think Joe Horowitz just said a moment ago about the ill-posed problem. So imagine your inverse 2,000 by 2,000 covariance matrix. So certainly you're getting a very ill-posed problem. That the conditioning number can be very small. So now the question is, how do we change the problem a little bit and making the problem more stable or insensitive to this? So this is, it's a good idea. There's always a few groups work together simultaneously, from applied math group to operation research to statistics and finance, right? So the only thing that we add here is one extra constraint. That is, the growth exposure is no more than C. So let me explain a minute what growth exposure means. So we have a long stock that you hold a long position, you have short stock. So all what I really saying that the long plus short is no more than some constant C. Okay, so by adding this, so actually I get just like what Steve talked this morning, it's become a conditional allocation, that you are talking about the optimum among a small subset of portfolios. And okay, so here, the linear constraint here, you could put either on like expected returns, right? For example, I want expected return to be 10%, expected return to be 15%, so you could put on that, or you could put on the sector allocation, no more than 20% on technology, no more than 20% on food and services, utilities, and so on. So you could put sector constraint on here. So the important here is that the L1 norm that I put down here, which basically putting constraints on the short positions, because the positive position you put plus negative position you put should be bound by C, and on the other hand, the positive position plus negative position you have should be 100% of your portfolio. So by adding these two together, so the constraint that you put down here is equivalent to put down the constraint on the short positions. So for example, if C equal to 1, so basically it means that you do not have any short positions, right? So C minus 1 divided by 2 will be 0. So in other words, you can only buy stock. Somebody like me, conservative, I only hold long stock. I never hold, when I was younger, I hold short stock, but not anymore. And in Chinese market, no short is allowed, right? So if you ask hedge fund people or people in the Wall Street, what is the optimal C? Well, people maybe say, well, C equal to 2. So let's say if I put C equal to 2 here, that basically means that you allow yourself have 50% short position. C minus 1 divided by 2 is 0.5. And 150% long position. And in particular, if I'm very aggressive, saying, hey, I don't want any constraint, I just want to find absolute optimal, then this is Markovitch problem. So in other words, we bridge Markovitch problem by introducing a gross exposure parameter C. So it's a continuous run from no constraint on the portfolio, which is the Markovitch portfolio, to the no short sale is allowed. So it's really a continuum that from conservative to aggressive portfolio. And the solution to this is usually sparse, thanks to this kind of L1 with many corners in the high dimensional space. So therefore, you could imagine as C equal to 1, let's say give you 30 stock. If you increase C to 1.1, maybe give you 31 stock. C equal to 1.3, give you 32 stock. So you could produce a portfolio of assets allocation as you relax your C from small to large. Okay, and of course the method that what we are talking here also can be applied to any coherent risk measure instead of just covariance or the variance of the portfolio that we apply here. But importantly, also just as a scientist in a similar spirit to what Steve will talk or Joe will talk this afternoon. So in finance literature, people observe empirically the following fact. Okay, so if I choose my optimal no short sale portfolios, and it will usually outperform the Markovitch portfolio. In other words, with wrong constraints, that is, I put myself to be very conservative portfolio, and usually it's better than the optimal Markovitch portfolio. And they ask themselves the question why. They're trying to explain this, but I don't think they go as deep. In addition, you could ask yourself, okay, it is true, let's say no short sale portfolio has risk here and Markovitch portfolio has risk there. Now, does it go directly increase into there or go down first and then increase into there? So this certain question need to be answered. And to answer this question, we certainly need to introduce a parameter C here that bridge the 2 points. One is here, the other is there. Okay, so this is the background of my talk. Let me see if I were able to use it. Good. Okay. So now, what is the good of introducing gross exposure constraint C there? And this is really just 5 cents mathematics. Jianqing Fan many years ago. I know that. So let's say this is the utility, expected utility. That is your expected return subtract to the variance. Okay. So this is the risk and return trade-off frequently used in financial economics. And now you just calculate the expected risk based on the sample you estimated. So this is the expected utility you get, and this is the expected utility you want. So certainly it will be just equal to this one minus your estimated one, right? So this is certainly bounded by the maximum components-wise estimation error times L1 norm of your portfolio weights. And L1 norm, according to my criterion, should be bounded by C. So you could see that, first of all, you can easily see that there is no noise accumulation effect, okay? So even though I estimate 2,000 expected returns, so at the end of the day, well, if I have gross exposure constraints, so at the end of the day, it's only the maximum components-wise estimation error matters. And similarly, if you look at the risk terms, the risk also depends on the components-wise estimation error. So therefore, if I put down the gross exposure constraints, this gives me a lot of mathematical advantage. That is, there's no noise accumulation effect when C is small. Let's say C is equal to 1, certainly it's the smallest you can get, C equal to 2, or maybe a little bit more liberal, say C equal to 3. And the good thing of this math here doesn't depend depend on singularity or I mean, ill conditioning a coherence matrix, but it's just always hold whether the sample size is bigger than SS. Let's say if I have 2,000 stock, if you want to get, coherence matrix ill condition, you need to do some tricks, right? Otherwise, sample coherence matrix is always degenerate. So now, if I apply this to the risk rather than utility, which is what I'm going to focus from now on, because I don't want to deal with estimating the expected returns. It's just an order of magnitude harder, and I don't want that to confound with the problem I'm studying. So by doing the similar way that the perceived risk based on the data and the true risk you get actually is also bounded by the components-wise estimation error times c squares. And then people may ask me why I don't put a norm, because I know there's a lot of great mathematicians here, including Wolfgang, wouldn't be happy to put a norm, because I know the components-wise estimation error is not a matrix norm. So therefore, I just put the absolute value there, so to avoid confusion for those people thinking it is a norm in high dimension. So the good thing, this is a very long way to say just a very short summary, right? So by putting gross exposure constraints, by putting a gross exposure constraint there, you will not, by putting a gross constraint there, so you don't really have noise accumulation effect. It depends on really only elements-wise estimation error. Somehow my pause disappeared with the Mac. I do have a pause in each slide, or maybe I sent the wrong version. But anyway, all right. So this is a little bit saying a little bit deeper, just with the mathematical notations, but a little bit deeper on the risk approximation. So this is the risk that you want. Let's say suppose there's something called true coherence matrix for the next holding period. Okay. So this is the true coherence matrix, and this is the risk you perceive or you get based on your data. You feel that is your risk, and in practice, so this is the optimal allocation with gross exposure constraint C. That is, if you are orgo and you know the true coherence matrix, so this is the allocation vector you will use. That is, you minimize your portfolio risk subject to the gross exposure constraint no more than C. And this is in practice, none of us have Oracle, Warren Duffy doesn't want to assist me. So all you really get is based on the data, right? So this is the allocation vector you really actually allocate based on your best belief of the coherence matrix. So these concepts we could certainly define. This is the optimal allocation vector. This is the practical allocation vector, and this is certainly the Oracle risk. That is, if you really know the true coherence matrix, you allocate this way, and this is the risk you get. Okay. And in practice, you certainly don't have that. So this is your estimate coherence matrix, and this is your constraint you put down, and this is the perceived risk of your empirical risk. This is known to you, but actually your portfolio is in the market, so your portfolio has to subject to the true coherence matrix rather than your estimate coherence matrix. So in other words, we have three quantities here. The Oracle risk, which if you know the coherence matrix, you know what to do. Your empirical risk, this is available to statisticians or quantitative finance, financial econometricians, and this is really your portfolio, being the actual risk of your portfolio. And with the maximum components-wise estimation error, it's very easy to show that the risk among those three quantities are all small. So this is the actual risk of your portfolio, empirical allocated portfolio, and the Oracle risk is no more than 2an times c squares. Again, I think Jianqing know long ago about this, and the risk of let's say the empirically allocated, portfolio putting in the real market without putting n here as a real market, and what you really get is no more than this, and so on. So all those three quantities are close as long as C is not very large and components-wise estimation error is not very large. Okay, so now the natural question you may ask is, how does components-wise estimation error, the maximum components-wise estimation error, depends on the size of your size of your investment universe. That is depend on the P that you are beginning with, 2,000 that I was talking about, and this is really like another 5 cents mathematics. So basically saying that if you were able to estimate each element's wise estimation error with certain rate, and then with exponential tail like this, then the components wise estimation error is just root n times log p times of that A. So in other words, the dimensionality or the number of assets enter into the number of assets enter into the inference of your final decision is only a logarithmic order. So the impact dimensionality is limited, and if you don't like here exponential tail, you could put the polynomial tail. So all you really need is just to inverse that tail, so you'll get the impact dimensionality. So in short, the impact dimensionality is really limited if you put gross exposure constraints. So now, just going back one more before I bore you with mathematics, how about if Markowitz situation, C equal to infinity? Then of course in coord is useless, right? It's always correct, but in coord it's useless because so wide, there's no use. So this in coord only makes sense when C is equal to 1, the smaller you could get, or 2, or maybe 3. And to demonstrate this also explains a lot of deep math behind. So this is using one of the simulation example. So when C equal to 1, this is no short sale constraints, and in the simulation I'm Oracle because everything designed by myself. I know everything about the random behavior. So certainly I was able to compute the Oracle risk. So the Oracle risk is indicated by this black curve. So when you have no short sales, the risk is there, and when you allow short sales, risk certainly decreases until at one point the constraint is no longer binding. So in our case, maybe C is around 4. When C is around 4, the constraint is no longer binding, so therefore it will become constant. So as you further increase your allocation level, it will not decrease your risk. So this is the Oracle. So in other words, there's a law of diminishing return for the Oracle risk. After a certain one, the gross exposure is more than Markowitz, theoretical Markowitz constraints, the risk will be flat. And this green line is the empirical. Empirically, you are always very optimistic, and the risk keep decreasing, and the risk could be as small as 0. So in particular, if I have more stock than sample size, then my sample covariance matrix will be degenerated. So here I use sample covariance matrix as an illustration. So then my risk could decrease all the way to 0. Now, so in the practical situation, when your C is so large, your stock allocation, because sample covariance matrix is estimation very badly, so your really investment portfolio is like a monkey picking a stock at random and invest in the market. So the risk of that could be very high. So in the picture I'm drawing here is just this high, but in practice we could also do simulation just as high as there, because it's a monkey type of investments when the constraint is so large, sample covariance matrix is estimation so badly, so your portfolio really looks like a random investment. So the risk could be higher. So this is why I explain you got a curve like this. So the actual risk of your empirically select portfolio always go like this, decreases, and these are very close when C is small, and then increases, and increase could be all the way up there. So in the simulation, we didn't do as extreme as the real data we actually had done before. Okay, so all this is a very long way to say just one very simple things. It's good to put portfolio allocate. It's good to put constraints on portfolio allocation, and the risk approximation depend only on components-wise estimation error, and the no noise accumulation effects whatsoever will be involved. So now in practice, so this is really the starting of today's talk. What is the portfolio selection with varying covariance matrix? So in order to communicate a little bit better, but you could ignore the mathematics, but in order to communicate a little bit better, imagine now I'm standing on today, and you and I agree that we are going to hold the portfolio for a period of time, right? So the return of your portfolio will be the return vector of those P stocks at the time, from the time t to time tau, right? So which is really just your vector plus what this cumulative return of your stock over this time period of tau. And now if you are talking about what is the risk, so you could calculate the variance of this risk, which is certainly because I don't change my allocation during this time period tau. Tau is, W is a constant, so it's certainly W times covariance matrix with respect to tau times W, right? So in other words, standing on today, time t, and what is my expected portfolio risk in a period of tau. And so this is really allowed like stochastic volatility in the next period, and this is projection into the future. We will never know, even if you are really the oracle, you will never know what is the next period. So this is another way to say that it's more important to have a portfolio that doesn't depend very much on the estimation error of your covariance matrix. Okay, so once I do this, so this is SU is instantaneous covariance matrix at any time t, okay, or any time u. So this is a conditional expectation at this moment. What is next period of portfolio returns? So our problem now becomes like this with time varying coefficients. So the same way, now I just want to emphasize that your covariance matrix depend on time. I put in L1 constraint here. So other than that, everything else the same. Now, how do we make our possible allocation possible? We are relying on two things, right? So one thing is what I would call continuity. So if your holding period is just 1 day, or maybe 2 days, or maybe a week, then you could expect that let's say the last 1 week's covariance matrix, average realized covariance matrix, and the next 1 day's realized covariance matrix is more or less the same. So this you are really relying on the continuity. I mean, if I really want to hold very shortly the period, so what you really want is what is the expected volatility tomorrow for 1 day, realized volatility. So there's no way you could get that unless you are using what's so-called continuity. What today's would be a proxy for tomorrow's. I would be very nervous if you say, hey, I use last year's today as a proxy of tomorrow's. That would be very dangerous. Now, this is less a problem if you have holding for a longer time horizon. So if I hold in, let's say, 1 month, then the average of my next month covariance matrix and the average of my last year's or last 3 month covariance matrix, that should be more or less the same if you assume the stock has some kind of mean reversion or have some kind of stationarity. So the average of next 1 month covariance matrix and the average of last 3 months will be about the same. The average of last 3 months is known to you, so you'll be able to do. So a lot of us actually doing portfolio allocation is based on long holding portfolios. So in other words, you rely on stationarity to get that. So now, so that's what I'm trying to say is, I mean, why the importance of putting an allocation vector there. So even you observe the realized covariance, even you are oracle, you see in the past. So I assume you are oracle seeing in the past, but don't fully see into the future. So it's a limited oracle. So if you see the realized covariance matrix of this SU in the realized covariance matrix of this SU in the past, I mean, you still cannot get the future one. So the future one you can get is at best as an approximation. So therefore, it's very important to reduce the sensitivity of allocation vector on your projection of the covariance matrix. And I argue already mathematically that gross exposure constraint is an effective method for this kind of purposes. All right, so now again I meant to be my pause doesn't work, sorry for that. Or maybe I sent the wrong files, but usually it's not as crowded as you look. So here's again, I just emphasize again, just to coin in your mind high and versus low frequency data. So usually low frequency data we refer to daily returns, daily close returns, and you usually using 1 year with 250 trading days or 2 years with 504. I'm sorry, my math doesn't work. Sorry, it's too late in the afternoon. Okay. And usually what do? You get your estimated covariance, whatever best you can do is you get your expected covariance matrix in the past 1 year or in the past 2 years, right? So this is the best you can do, getting your estimated expected covariance matrix in that. And that can be very different from the expected covariance matrix you want for next day, next week, or even next month. So certainly the idea cannot be applicable to the short-term and period day trading, and it's not clear, how long is long-term period. It's only applicable to long-term holding when the data is stationary. Now, what is the advantage of using high-frequency data? High-frequency basically is tick-by-tick data that I have in mind. So first of all, you have certainly more data available for you to estimate covariance matrix. So IBM been traded over 10,000 times today. So you certainly have more data about the volatility. Usually what you see is here and you end up there. You don't really see in between. So therefore you don't know how volatile the stock or changing is. You only see the starting point and ending point. Now you have intermediate data. So you certainly have more data to estimate the covariance matrix. And it certainly allows you to shorten the time interval, because now if I really want to hold stock for only 1 day, it allows me, I could use my past week's data. It's still a lot of data, but I cannot use low frequency just for last 5 days. It would be certainly not informative enough for me to make an informed decision. So therefore it would be adapt better to local correlation, changing environments, and so on. And the method certainly apply to both long-term and short-term holding periods. Okay. So now let me get to the covariance matrix estimation for high-frequency data. So as I said before, so all the estimation error is depending on the components-wise estimation error. So this is another beauty mathematically of gross exposure constraints. So therefore, I need just to estimate each element separately based on high-frequency data. And at the end of the day, I just form a covariance matrix and I'm done, because theoretically speaking, only components-wise estimation error that is matters to you, okay? And now the question you may ask, hey, what is the big deal of high-frequency data? What is the style features of high-frequency data? So there are certainly a couple of co-authors here, include Frank Debo. Trying to model those in very early days, like 2003 and so on. I just throw down a few names here. That's by far not exhaustive. The reference itself is very long. So first of all is microstructural noise, non-synchronized trading, and the jump in the data, and there's even a lot of issues on data cleaning for high-frequency data. So by microstructural noise, you could imagine, the trading within millisecond or maybe within half a second, you really don't know whether it's a signal there or just a random placement you and I would like to play, right? So you don't really know it's a noise or it really contains a signal about volatility. And non-synchronized trading is very clear. IBM trade at this moment, Intel maybe traded 2 moments later, and the Intel maybe have another trade before IBM have another trade, right? And the jump, when the news arrival, they sort of have jumps and so on. Okay, so the way that people usually handle is thinking, hey, you have latent, you have for the I stock, and now I take away the I. For the J stock, I take away the index of J. So for a particular stock, what you really observe is the latent log price plus idiosyncratic noise. So in other words, this is the true log price, and then you plus measurements error to you, and add all those together, you observe is your signal plus noise. And and this is for individual stocks. So I could certainly, estimate each diagonal elements of my covariance matrix. So in this case, it's become the integrated volatility for each individual stocks. So there are many methods, again, by far exhaustive, many methods for estimation elements-wise estimation error, and two statistician here is really no big deal, right? Because estimation of variance, how difficult it could be, even in presence of microstructure noise. Maybe just because it's simple, so there are so many other methods and so many people jumping and doing it. So I will just give you a very simplest version of doing it in a second. So but in other words, my model is you don't really observe your log price, your log price plus error. So in other words, you observe a multiplicative error if you really want in more original scales. And so the method that involve basically like say two-scale or multi-scale realized volatility or realized kernel methods, or if you like, you could use smoothing methods such as waveless methods or other robust methods to detect jumps. You could also have like apply some kind of smoothing or quasi-maximum likelihood methods. So let me not go to all detail. Let me do you the most elementary ones because that's easier to communicate, which would be two-scale realized volatility methods. And this is the idea of realized volatility, which is really just the difference between two observations. Okay, just taking consecutive difference squared, or if you do subsampling, you take once every let's say 5 data points, right? So you go like the difference from here to here. So once you're taking more, subsampling, you increase the signal, reduce the noise, right? You could easily imagine because if you take once every 5 points, you accumulate more signal, but doesn't necessarily accumulate much of the noise. So you do this. So this is the what we call subsampling or realized noise. So you're just taking every 10 minutes return, and then put a square of those, and this is your realized volatility. So if you really compute those, it's very easy. It's equal to integrated volatility you really want. That is expect integrated volatility in the past, and then plus the noise here, and the noise here, because I take difference, so it'll be two noise together, so it'll be n data point times eta squares. So in other words, so if I take this will be the subsample you get, and then of course you say, hey, you could take every 5 seconds like this, you could take another every 5 seconds like this, right? Starting from second point, this will be 5 seconds and 5 seconds and so on. So you get k different kind of this. So you certainly say, hey, let me take the averaging of those subsampling realized volatility, and if you do this, is nothing but just saying, hey, I add in all those consecutive k data points squared divided by k. So this is very simple. So in other words, after you do subsampling, you still get signal plus noise, and when this ns is large, ns is that just like average data per block. In my situation here is 5. Okay, so when I have 5, so when this ns is large, actually the signal dominate the noise. Okay, so noise dominate the signal. So one statistician would say, hey, if I really want to get the intercept, which is really the number you want, and this is really the slope, so how would you do it? You and I would say doing regression, right? Because for every given k, you have design here, so you could just do simple linear regression, and simple linear regression will certainly give you the intercept and the slope. The intercept would be, the integrated volatility, and the slope would be your microstructural noise. And you could do like, if I want to get my estimate of the theta at minimum, I should need 2 different cases, right? Subsampling or every 5 points, and the plus subsampling at every 1 point. That is, I use all the data. So this is, if I use 2, the estimate based on every 5 points, I got this equation. I got estimate based on 2 points, I got this equation. So you have 2 equations with 2 unknowns. You could easily solve it. You got a 2-scale realized volatility, symbolically very simple. You just take every subsampling of k points and every data point divided by k. The difference between these is your two-scale realized volatility, and it has been proved by Zhang, Micklin, and Aissa Halia that 1/6 two-scale realized volatility minus theta would be asymptotically normal with mean 0 and variance like this. So, and the optimal choice of k is k to 2/3. Okay. So for our application, I mean, we really need more than that, because not only do I need that the rate of convergence. So rate of convergence N16 is how many trades you have per day. Okay, so this is still a lot of data. Even though 1/6 is slow, but you know every day you got tens of thousands of trades for those liquid stocks. So it's still there's a lot of a big number there, and so if you do what we did in this paper is we proved that. For x is no more than 1/6 of c, so basically it's large deviation type of result. Then you have 1/6 rate of convergence plus exponential tail. So as a result, so if I estimate my diagonal elements, so I have maximum components-wise estimation error. So by theorem 2, so the rate of convergence would be log p divided by 1/2, so this is inverse of this exponential tail, times n to 1/6 of the slowest trade stock. Right? Remember, I have many stocks in trading, so this is the slowest effective data I have. Okay, so this is two-scale realized volatility. And this rate can be improved to n to power 1/4, and this is using multi-scales. And I believe multi-scale methods motivated extremely differently from what I was talking here is just a regression of this on this. So you could improve rates to n to 1/4. So Zhang certainly motivated mathematically from very different view, but I believe it is just the multiple regression. Okay, so this is so now I have an estimate. So in other words, how do I estimate using my high frequency data to do my job? I just using each stock's high frequency data, and I just put estimate in each. Integrate volatility on each diagonal elements, and therefore, mathematically speaking, I will have rates of convergence like this. So the noise accumulation is not very large because of this large deviation result. And those C, I know that, let's say, Spokojny maybe already asking, are those C depend on individual stock J? So under my assumption, it will be not. In other words, we have explicitly constant here C to control these. So don't worry about that. So now the next issue is how do I deal off diagonal elements? And this is usually what's so-called data synchronization. So the data synchronization idea is very simple. So basically saying that, okay, so starting from 9:30 in the Eastern time, so stock is open, and the first access and the third access already trade once, right? And then followed by the second access, and then followed by the third one. So you are waiting until all of those assets trade once. So let me call this time tau 1, right? So the slowest guy wake up, right? So you are waiting until slowest guy wake up, and then you could imagine as if you have now your observed data at this tau 1. Okay, this SS2 certainly observed at this tau 1, SS1 as if you have observation in this tau 1. And now you forget about history and wait for again the slowest person to wake up. In this case is again the SS2, right? So SS3 already trade twice, but SS2 just trade here and SS1 trade here. So again you take the slowest one and then moving all the observation here. So you know the price for the second SS. Now if you are waiting for the again waiting for the slowest, so this time the slowest is the third SS, right? So you are so you have observed data here. This one you're thinking you have observed here. This one you think you have observed here. So this is the data synchronization scheme. So in general, data synchronization scheme we really need is the arrival time, the difference between arrival time to be like IID and with the gap uniformly of order 1 over n, and at least there's one access in between this time interval. So let me not get too detailed on that. So once I got data synchronization, then I could easily define the off-diagonal elements. So each off-diagonal elements is very similar to the diagonal elements. Now the only difference is now you have two assets, right? So you are using just slightly realized variance now become realized subsampling covariance. So this is the only thing that you change. And the number of observation is now the number of synchronized data per stock in a particular day. And then the rest of concept you really could just extend directly. So sorry for the mess. I should have a pause, which looks much nicer for each of those bullet points. And this is the, you could apply the realized kernel of, or you could apply the quasi-likelihood one, that is covariance is just equal to the variance, the summation of two variance and the summation of the difference of two variance. So you could apply either one of these, you get the off-diagonal elements. And of course we are lazy just analyzing these methods because mathematically the structure is a little simpler, and we did more or less a year ago, but never published, anyway, never even submitted a paper. So we've shown the same thing, that two-scale realized covariance matrix, and this is the integrated, this is the object you want, and this is your estimate. So the difference is, again, it's 1/6, and then times exponential tail. So again, we got the large deviation type of results. And here I just talk a little bit more detail on the assumptions. So we assume each asset is, Brownian semi-martingale with realized instantaneous covariance matrix like this. And here is the constant C important. We assume that the stochastic volatility is bounded by some constant uniformly among J assets you have. We also assume that synchronized time is no more than C delta by 1, and the noise is independent of assets. So all those C that you see here is really related to those two C's. So in other words, as long as this mathematical assumption holds, you will have results holds uniformly. Okay, so now this is a long way to say what I have said so far, but really what I have said so far is very simple. So how do we do portfolio optimization? All right, so first of all, you have, this is the problem we want, right? So you want to minimize your portfolio variance subject to the gross exposure constraint no more than C, that is your short position no more than C minus 1 divided by 2. And now how do I get an estimate of this sigma hat based on the high frequency data? I basically say, hey, let's take last 5 trading days data, and each day you will be able to get the diagonal elements by just calculate the integrated volatility, return on integrated volatilities, and each day for each 2 pairs of stock, you could also compute the covariance matrix. And so once you're doing that, you just don't even need to bother whether it's a positive definite or not positive definite. This mathematical problem can always be well formulated. And whether the solution is not unique or not unique, as a matter of fact, that the actual risk is no larger than this away from the real one. So thinking C is equal to 1 or C equal to 2. So you have really finite sample, whether it's a positive definite or not negative definite. Now in practice, there are 2 possible methods that you could do, and this is actually, that's why it takes us 1 year. It really takes us a long time to understand why mathematics sometimes doesn't match with the reality, even in your simulation. So you have two possible ones. One is that you do pairwise refresh. So you are just estimating components wise. So I don't have to wait until 30 Dow Jones industrial stock trade at least once. I could just do IBM, Intel, IBM, Intel, IBM, Intel, and then IBM, Microsoft, IBM, Microsoft, and so on. So I could just do this. I could get the covariance matrix estimation. So theoretically, according to the mathematical result we have, you get components-wise estimation. Again, is the dimensionality is log P times the slowest guys. The slowest guy is the pairwise refresh, data after you are waiting for the other slower guy to trade, right? So this is the pairwise, the minimum of pairwise refresh time. So imagine for a particular day, I have a pair of stock running. So every time I have to wait the slower one trade once and then forget about history, and waiting whoever slower one trade once forget about history. So for any pair, I will have Nij at the end of the day, how many data available for me, and this is the estimation error. So the other one is that I wait all 30 stock to trade once, right? So this I call all refresh. And then just starting from that point, I wait for all those 30 stock to trade another times. And so in this case, I will have the rates of this, and this sample size and star is certainly slower, and mathematically smaller than this guy's. Okay. So this is certainly a smaller number than this one, but interestingly, in many simulations, those are not very different. Okay, so in other words, I have two use of high frequency data. One is pairwise refresh, the other is all refresh. And now here is, I think, one thing that kills us really. So this is optimization problem, but I need to find some software to solve this when this sigma is not positive definite, is non-positive definite matrix. But all the software, the quadratic programming software we found is always asking sigma to be positive definite matrix. And we do a twist, and this twist, I think, is the price that cost us so long to finish the project. Okay, so the programming algorithms require your estimate correct matrix to be non-negative definite, but unfortunately I only estimate elements wise, so I can never get that. So we do two possible projections. One is just least square projection, right? So you do singular value decomposition and then project all negative eigenvalue to positive domains. And this is the one that we are doing, And the other possibility is, hey, let me raise, just like a rich regression type of method, so let me raise all the matrix by the minimum eigenvalues. So now the minimum of this one will be 0, and then just normalize by 1 minus sigma. So this is the method actually we are using. But in both methods, we really don't change the eigenvector. So eigenvector is always the same as your original estimate one. And once I got the wrong eigenvector, I will always get the wrong estimation error. And in application, what we really do is apply to the correlation matrix rather than volatility matrix itself. And unfortunately, this is the part that we don't understand. Maybe somebody here would be better, more suited to mathematical to help me understand. This is how does it impact on the elements-wise estimation error? Because once we raise or change something here, so elements-wise error been changed too. And we don't know, it seems to me that it has quite large and adverse effect on the coherence matrix. So the main reason that we will suffer is that I don't think clearly we have anything wrong. I think what we really suffer is that we really want to solve some of this, but we are not good enough programmer to solve this with negative definite matrix. So I need to feed it into a positive semi-definite matrix, and therefore I do alternations on my estimation. And because alternation on my estimation, I got also everything messed up. So at the end of the days, we were always struggling. So this is what I'm trying to really making a remark. So it appears to me that the projection distort more pairwise refresh method than all refresh method, because all refresh method is like a sample covariance matrix. You are trading at the same time, you are like calculating sample covariance matrix. So therefore, it's more closer to non-negative definite than pairwise refresh. So therefore, the smaller components-wise estimation errors for pairwise refresh, because it have more sample size, may not be realized in implementation because we alter it. And the other problem, whatever we are talking about here, the pairwise refresh or components-wise refresh is always an upper bound. It's not really the actual risk. So it's we really don't know. And we really, until after we try half a year, so we actually think, so hey, let's do silly things, okay? So I got a sample covariance matrix 2 by 2, right? So just do 2 stock, 2 by 2 stock. So this is my sample covariance matrix. Now granted you that in simulation I know the actual covariance matrix, so we just replace the first elements here of this 2 by 2 by the true one. So certainly I have no components-wise estimation error already. And we found that actually the performance is not always better, actually only about 65% better, even if I know one or two the true elements in this 2x2 matrix. So because of this, that pairwise refresh not necessarily perform any better than this. So now let me give you an empirical study. Is that the point that we want to illustrate? And again, this is empirical study. It looks easy, just like making movies. You see only for 3 seconds, but actually run for us is run days and nights and nights. All students knows what I'm talking about. I just want to pay sympathy to my student because I always say, hey, you are too slow. But actually what you do is a lot of things. Okay, so we have 30 stocks from Dow Jones Industrials. And we take, I think the period is January 08. This is 9-month period that we are taking. And the holding days we are intend to hold for a week. During those 9 month days, I think they have over I think I must lost 1 0. Okay, 2 million. Maybe I have 3 more zero at the end. Trade are there. When you have not enough number, you just add in 3 more zeros. So on average is that you have each stock each day is trading about 76,000. So to put you on the right scale, so I think it's basically like 1 second on average you trade about 3 times. Okay, so every second trade about 3 times. So we got the 13G data. So it's very hard for unexperienced non-computer scientists like us to handle this kind of data. My student was never been taught how to handle large data, so he learned himself different kind of software and so on. And we hold it and rebalance weekly. Okay. And this graph just show you trading frequencies. So this is the maximum number of trading each day. So I have 200 days or so. So this is the distribution of the maximum number of trades per day. And this is just compare the median of number of trades for, I think, pairwise refresh. Also, this is the minimum number of trading days for the slowest guy each day. The minimum number, and I have a distribution over 250. 200 days. So this is the trading frequency for the least frequent one, the distribution for least frequent one. So even that for this Dow Jones Industrial 30 is a highly liquid stock. So the minimum one actually trade about 20,000 per day. And this is the median, so just to give you an idea how frequent the trading is. And I think one of the reasons that we always have is that the pairwise refresh for this liquid trade stock doesn't really change very much. And so we just hold for 5-day rebalance, hold for 5-day and rebalance. And this is the risk that we are comparing. So this is the low frequency data based on past 100 days estimation of covariance matrix. So as we increase gross exposure constraints, so the C here is as we increase gross exposure constraint from no short sales to 25% short sales, it could increase further. Actually, I have a graph of this larger scales. So the low frequency one is always on the top, and the high frequency one, because you are estimating covariance matrix better, so therefore your actual risk is quite a percentage below that. And then the other is a summary of Sharpe ratio, then other characteristic of the portfolio. So let me not go detailed to it, but the moral of this story is that Alice in Wonderland again. Every story got to have a moral. So the moral of this is that by using high frequency data, you are adaptive better to the local correlation. You have far more data. So adding these two together give you a better estimation of expected covariance matrix in the next 5 days. So as a result, high frequency one doing better. And what really takes us trouble is we always trying to prove that pairwise is much better than all refresh. At the end of the day, we give up our original belief. We believe that pairwise, all refresh is performed no worse for a couple of reasons that I was talking in the remark before. And then you may ask me why we choose 2008. And 2008 certainly is high volatility years, so therefore time varying can be better seen. So low frequency, a little bit clumsy for 2008. I'm looking in past 100 days is a lot of impact on that. So this is what we do. And then we also do simulation studies. So let me just quickly run through the simulation studies. Again, sorry for the mess of transparency. It doesn't look quite like that. So what we really do is P stocks which follow one factor model, and the stochastic volatility follow Vasicek model, and the parameter we choose is follow the paper by Bandov, Nielsen, Shepard, and his group, and so on. So we choose actually the same parameters there, and all I really want to illustrate here is this. So the median of because of the Poisson process, the arrival time is really the Poisson process with arrival intensity. This is the number of seconds per trading days that we are using. So from very illiquid, from relatively illiquid, to very liquid trade. And so the investing universe is 50 stocks. This is already take quite substantial amount of time to program and to try. And so this is the summary of relative frequency. Oh, I'm sorry, I forgot to change this number yesterday. So all refresh, oh no, it is correct. All refresh actually on average is about 375 data per day for you to estimate the covariance matrix. And if I talk about pairwise refresh, the slowest one is 410. So the difference is not very big. So that's why the pairwise refresh doesn't give us a lot of gains. However, if you are talking about the median, here I'm talking about the minimum of pairwise refresh. If you are talking about median of pairwise refresh, is much bigger. And then we are adding like 5 basis point on the idiosyncratic noise, and so on. So now because we are doing simulation, we certainly know, the truth. And this is two, simulation sample path that we show here. And this is another thing that until too late, I advise my student to plot this. So I ask him just to plot to realize volatilities, and let's have a look how our simulation done. So if you see the realized volatility doesn't really have very large time varying. I know if you plot in this scale it looks like big, but if you imagine it's just really just 10% time varying. I think this is another problem with our simulation, that so we couldn't get the result we really expected. And because students nowadays sometimes doesn't look at graph until I suggest just 2 days ago, so we are not plot this, now we are changing parameters. I hope in another 6 months I should be able to report you a better results that we have been doing. Okay, and so here is talk about risk approximations. So just want to see how, again, now imagine I'm Oracle because doing simulation. I know exactly what the microstructural noise is. I know exactly what is the latent price being traded at each second. So therefore, I know a lot about the covariance matrix, true covariance matrix. So here we construct 4 portfolios. Okay, 4 very specific portfolios. Just trying to see whether pairwise refresh is better or all refresh is better. Okay, and this is also we try a lot of time until we realize this. So first portfolio you say, hey, let's do equally weighted portfolio, right? So the second one is more extreme. I just invest on the first stock. I'm not going to invest on the rest of the stock. And the third one basically say, hey, let me long on the first stock and the short on the second stock, and the rest I just redistribute equally weighted. And the fourth, and this is this second, third, and this is to be the fourth rather than 3 there. So I just put 200% on one stock and short 100% on the other stock. And now because we are doing simulation, I know certainly the latent price. So this is really like more or less, this really can be regarded as a true realized risk in this. So this is for, if you really Oracle, which I was, because I was doing design the simulation, and so I knew exactly what the risk is about, maybe 68% for this particular stock. And this, I don't know what the scale here means because we don't really normalize according to time. It's neither per annum or per month. So to forget about the scale, I need to go back and renormalize it. And this is the true risk, and this is all refresh risk, which is certainly underestimate, because as we said already, in samples is always overly optimism. And this is pairwise refresh, certainly it's closer than that. And this is just the median difference. So the difference between these two is about 10%, and the median between pairwise is this. So this is more or less in line with our mathematical theory, mainly because pairwise refresh give you more data, so therefore you got the risk is closer to the actual one than all refresh method. So this is for different kind of portfolio we are looking at, and also we are looking at portfolio allocation, and this is the typical graph that you will see. So in this case, again, I know the true covariance matrix. So as you increase your gross exposure, so this is the actual risk. After a certain while, there's law of diminishing return. The constraint no longer binding. So this is the risk you decrease all the way to here, and this is the all refresh method, and this is pairwise refresh method. So pairwise refresh is less stable when you increase C, because you are altering, I had to do projection, altering more on my estimated values. So therefore risk getting worse as you increase C, because it's getting more and more unstable. So this is just a zoomed version of this in this particular region. So I know I have been talking quite long, so let me quickly maybe stop somewhere. So this is, again, we do the similar outsample evaluation based on, you see we're doing all models just 20 times just to produce result, because we've never been able to get parameter right. But I think now we have quite good understanding of the whole problems, and I hope that I'll be able to report you better results later on. But suffices to say here, so let me just show you the graph here. So suffices to say that suppose you use high frequency strategy and hold for 5 days, so you still have 3 methods, right? One method is based on low frequencies, and low frequency here we define by using past 100 days estimation of covariance matrix, which is more or less the same as rich matrix we're doing. And so this is the risk with gross exposure constraint I put down here. So for example, when gross exposure constraint is 1.6, that means you have 30% short positions. The risk using low frequency is about here, maybe 16% per annum. Now this time we are smart, we at least normalize it in an understandable time scale. And so this is the blue one based on all refresh, and this is red one based on pairwise refresh. They are very close, which I now accept more the fact. At the beginning I was very unhappy, I said that can't be true, but now after doing all those, I believe they are closer because of many modifications that we have done here. So again, the simulation lesson is very similar. That is, if you use low frequency, you'll get always, because you don't adapt to local correlation, you've got a higher risk. And if you use high frequency data, you've got a better risk, and so on. So let me not detail you at this. So let me just quickly to conclude. And again, this is every story should have a moral, and this is the last thing that I want to summarize to you in 5 points. Okay, so first we advocate portfolio selection with gross exposure constraints. Whether you are using high frequency or low frequency, people always have gross exposure constraints. So to understand risk, we better to understand there's one norm on the exposures. And because we put in the components, gross exposure constraints, it becomes less sensitive to the estimation error of covariance matrix. Okay, so this is a mathematical fact we derive, really only 30 cents. And therefore, it has little noise accumulation effect because it depends only on maximum elements-wise estimation error. Now, for high frequency data analysis, we basically have 2 possible methods to estimate the covariance matrix. One is all refresh, that you're waiting until all stock trade once, and then forget about history, waiting for all stock trade another time, forget about history, so you could just regard it, you have synchronized trading at all those time points. So the disadvantage of this method is I have less data. Advantage of this method is I have non-negative positive definite matrix, right? Nearly, just thinking of sample covariance matrix, I have nearly non-negative positive definite matrix. So therefore, I don't have to do much more modification. And the other one I think at the beginning I have wrong intuition. Let me apologize to my students. So I was thinking, hey, pairwise refresh have far more data, so therefore you could estimate components whilst estimation error much more accurately, because you are just waiting 2 pairs to trade once, the slower guy to wake up rather than slower guy of 30 stock to wake up. But at the end of the day, it's our computational algorithm kill us, because we have to modify these non-negative positive definite matrix. So our result was not as expect as we want. So we propose all refresh and pairwise refresh to estimate integrated volatility, and we derive the large deviation results, and we demonstrate the limited impact of portfolio size on our portfolios with gross exposure constraints. We use high-frequency data to increase the sample size, to shorten the time window, and to adapt that to the local correlation. So as a result, we got a better result for, predicted for, for the risk that you want to analyze. And we demonstrate our utility of method by using empirical studies as well as simulations. So with all those, let me say thank you for your attention.
This is something in between these two extreme cases you're considering, and computationally much faster, and based on simulations and applications, we show that this performs better. So I would expect that in your application, this would be a real attractive alternative. And the second comment, a related comment, so the simulation results you're presenting, of course, this strongly depends also the assumptions on market microstructure noise. This is also what we found. So it's also these, particularly these pairwise combinations. Or this is, I don't know, it's kind of Hayashi Yoshida estimator, and of course this critically also depends on the magnitude of noise you have in your data. So that you can, of course, you can create different results, different performance of these different strategies. It depends on the noise you're assuming. I didn't see what you assumed for the noise, but that can be quite sensitive.
Yeah. Okay. So let me respond to both of your questions. First of all, block-wise grouping is certainly a good idea. Each stock itself have different trading frequencies. So, you see that our part is a little bit extreme, but on the other, not as extreme, because at this moment, we are applied to Dow Jones 30. So in a sense, we are already grouped, because Dow Jones 30 are all highly, liquid trade. So, actually, that's the problem. My student were implementing, but I didn't really go check it every day. When I was thinking in my mind, I was thinking there must be one very slow guy or a few very slow guys that slow everybody all pairwise refresh down. But unfortunately, he was using, I would always think he was doing SP100, which is also quite liquid trade, but at least there are some slower guys would be much slower than fast guys. So he was doing actually SP, Dow Jones 30. So in that sense, we are really very close to the spirits you are talking, because even if I try to group it, it will not differ that much, because those you really don't know which of those stocks are faster trading. But I agree it's a good idea, and I mean our own lesson was like we didn't really design in the domain that I would like to explore. So certainly I suggest 2008 is the correct time to see different time scales or changing volatilities. But I will also suggesting high and low trading frequencies. But unfortunately, students using all high liquid trade one. So this is the first one. So the second one, I mean, the microstructural noise that we assume here is, I mean, for simplicity, we assume it's IID microstructural noise. And of course, Hayashi and Yoshida method is the first generation one, quite awkward. And nowadays, after a few years, people know better how to estimate covariance matrix. And the methods that you could do actually cannot much worse than the Hayashi and Yoshida methods. So in this particular study, because we are not talking about high frequency estimation competition per se, we didn't compare with their methods, but basically we are using, if I really want to use, I would really use multi-scale or, or refresh all these realized kernel methods, which in our experience working quite nice. And the quasi MLE method that we are using is also very nice, that we have demonstrate better than Hayashi and the Yoshida methods, and we even compare how much data. So you probably see one of those times that we are deleting, we even compare with effective number of data with them. So it's in a very different study, but not on this one. So in other words, that the microstructural noise certainly has an impact on the estimation of covariance matrix. But but high frequency data always give you more data to getting estimate. And this one of the reasons we are studying on this issue is the high frequency data has been studied, maybe Frank knows, over 15 years or 20 years. I don't know how many the practical utility of high frequency data actually being used. So we were just trying to explore one on portfolio location and risk assessment. So just one of the practical ones. Yeah.
Okay, so here is found there is a kind of maximal error in estimation of the covariance matrix. And it's clear that actually is related to less frequent stocks will contribute more to errors.
Yeah, so the less frequent stock will introduce more the error. Yeah, you're absolutely right. Yeah. Yeah, so I see you're getting good. Yeah. Yeah, that's absolutely correct, because this is, the first lesson we learned, right? So if you have less measurements on one asset, you should downweight because you are less reliably estimate the risk. So you should downweight that. So yeah, in this version we didn't do it, but the mathematics doesn't really change very much by putting weighted. I'm assuming weight is prescribed by you. In practical version, I certainly would do, let's say, weighted one, and the weights usually will be disproportionate or to the frequency being traded in the study period that you are making. No, this is certainly a good idea. Then the estimation error is not components wide, it would be weighted components wide estimation error, but the bounds can be similarly get. But this is a good suggestion in practice. You certainly do weighted ones. I was thinking non-weighted one maybe already get people lost. Apparently you are not sleepy. I thought non-weighted one would get people lost. Weighted one certainly get people even more lost. But that's certainly a good suggestion.
I have a question about the regularization strategy that you use. Ultimately, when you're doing GMV, it boils down to you're putting weights on the inverse eigenvalues. And the concern is by treating what are effectively non-signals and regularizing them and then inverting them, you take that inversion and put a disproportionate amount of weight on what's effectively noise. You consider maybe doing a factor structure, which would, in effect, what you want to do is you want to put, have you considered that
Yeah, so among the whole papers, if I self-criticize, everybody criticize themselves, right? The whole papers, the weakest spots, you are exactly pointed out. This is the part I don't like, okay? So that is, this is I mean, I wish that I'm an optimization myself, then I know that the problem, even this kind of problem, there exists a solution, because mathematical theory could be any solution in this, any solution in this would satisfy my mathematical theory. Even there's multiple one, you pick one, probably not too much wrong, and I force myself to alter my estimate. And my alternation of my estimate has a lot of adverse impact on the components-wise estimation error, and that's why we cannot demonstrate the results. So I always try to learn if somebody have better idea how we could solve one of the two ideas, but you are mentioning one of those, I certainly would be happy to listen more careful, but it's difficult. I know that even if we put in constraints, gross exposure constraint, which really making myself doesn't quite depending on the inverse eigenvalue, or at least less sensitive depending on inverse eigenvalues, but still this will have a lot of huge impact on my I mean, component-wise estimation error. So this is the weakest point. That's why we are still struggling. Luckily, my student will go to Wall Street. Otherwise, if he found an academia job, it would be difficult, because when you don't, you cannot allow yourself to make a small mistake in those computation or in the misstepping. But it's a good suggestion.
I have one more question. Do you have some support or expectation? Do you have some support or expectation? What would be the difference between these two approaches in one day, during, say, opening, closing, or in the middle of the day?
Okay.
There's some evidence on what to expect.
Okay, so yeah, so the question was that if I do like a day trading, and what is the expected difference between these 2 days? And this is actually a very interesting question. We are actually currently doing actually I mean, you could see a lot of risk assessment that we're using here. Unfortunately, my student was using based on daily close returns. And I say, hey, now we have high frequency data. Just the moment before I arrive here, I say, why don't you just use every 15 or 30 minutes return, then I have far more data, then we could really see what's going on at the end of the result. So I was hoping by correct calculation, so every detail, this is again always sometimes a problem that you are working with the co-author. Every detail you have to ask, at the end of the day, what he was implementing is different from what you were thinking. I was thinking high frequency data, he will certainly implement every 15 minutes return, right, so you could see better, but we are currently using closing data. So we'll certainly do that, and then we'll evaluate it. And actually I'm asking him very explicitly, just do 1 day first before you do 40 for 5 days, because then there's no market open and close effect, because we currently have market open and close effect. There's always a jump point in the morning and in the evening. Yeah. So I'm glad everybody's still awake. I thought I'm the only person sleepy. Thank you.